hope we're ready for our next one. It's going to be such a fun conversation. I'm going to introduce the moderator, Jeff John Roberts. He is the finance and crypto editor with Fortune, and he will introduce the rest of the panel.
Thank you so much. Hello again. I'm delighted to welcome a couple of the sharpest people in crypto finance. Caitlin Long, who I've known for years, has been fighting the good fight with Custodia Bank, and Kopp, who I confess to me for the first time, I certainly know ETHFi, which is, I think, on the sort of cutting edge of finance. And we're here to talk about the future of crypto banking. But first things first, can you each of you quickly say, what is crypto banking? How should we think about it?
Well, it's two things. One is just regular US dollar bank accounts for the startups in this space and for the users of crypto, so that if you send a wire back from a crypto exchange to your regular bank account, your bank doesn't debank you.
Yeah, for us, it's basically maintaining custody of your assets while performing any action that you can currently with a bank. So whether that's sending money, spending money, or investing money, we want you to be able to do that through ETHFi.
Okay, but in the crypto context, with sort of custody, how is it the same and how is it not the same as I think we all know what a bank is. They hold their money and there's a federal backstop to it, and they above all they cannot mess with our money. And the rules are kind of the same in crypto, or how is it different?
The rules are actually quite different, because the way traditional banking works is when you put money into a bank and the bank tells you you can withdraw it on demand, it's literally called a demand deposit. There are $5.7 trillion of demand deposits in the US dollar banking system right now. But the bank doesn't sit on vault cash to be able to cash you out. The bank turns around and makes loans with that cash, and that's the disconnect. There is, in crypto, some of that happening. Obviously, SBF did it at FTX. We've seen, BlockFi and some other exchanges get nailed by classic bank run type of situations. But the on-chain assets themselves are not subject to that leverage, which is why if you own, it's not your keys, not your coins. If you self-custody, you aren't exposed to that classic bank run risk.
Yeah, so for us, I guess there's a couple things. So the important thing with ETHFi is that we never take custody of the assets. So the user holds the assets at all times. So there's no rehypothecation of said assets when they come in, right? Like the US banking system, US dollars go into the bank, but I think it's something like only 5% of dollars are actually held at the bank. Everything else gets, go and make more money with said money. So for us, the assets are there. Now you can place your assets into different things where you can continue to earn your capital, but the bank run situation just doesn't exist because we're over collateralized. We don't do anything with that money because it's just the users holding their assets on ETHFi. One of the interesting things I think on that it is scary for people is actually self-custody. Custodying your own assets seems scarier than putting $50,000 at Chase Bank. We as Americans, you put $50,000 in Chase Bank, and yeah, it might only be open 9 to 5, Monday to Friday, but you're not worried, hey, my $50,000 might be gone. Where everyone's heard every horror story in crypto where their keys are lost or whatever, and someone's lost their Bitcoin seed phrase and has $10 million that's floating around somewhere. So
I've heard about that. Yeah.
Yeah.
No, but can you actually sort of? How does ETHFi sort of square that circle in that self-custody? I agree with you. I've lost seed phrases before. It sucks. At a certain point, you're like, oh, damn, it's just easier to park it on Coinbase, but you feel like you're not really doing crypto. So just break down for me the technology that lets people operate on ETHFi and self-custody without like the big headache of having to manage their own keys.
Yeah, so when you, our user flow is a little more Web 2. So you create an account with an email address, and then you have to KYC to get our credit card, which is basically creating like this vault. The vault is just a wallet that is created on Optimism now. We just announced that today. We're moving from Scroll to Optimism, which is a Ethereum L2. But your assets, your account basically sits there. And so we try to make the flow good for normies, I guess is what I would say. But you can bring in stables, ETH, Bitcoin, and then we have different products where you can either just hold them or you can earn yield against them. And you can also borrow and then spend with a Visa credit card. So it's a Visa credit card. We have two modes, direct pay mode or borrow mode. If you borrow, you're paying 4%, and you're just literally tapping a Visa credit card like you would normally. And then we work with Visa and just settle on a daily basis with Visa. It's all done in stablecoins. So Visa is actually really, really forward thinking with crypto, and their stablecoin business is a big focus. But yeah, so I guess the answer in short to your question is, when you go into ETHFi, you're creating a wallet on Optimism, and then you're adding funds that are being held in there. And we just kind of try and make that flow easier. You can on-ramp and off-ramp fiat, et cetera.
Makes a lot of sense. And turning to, I just want to pick up what you were saying earlier, Caitlin, about, yeah, banks, it's kind of shocking. If everyone went to the bank and asked their money, it wouldn't be there. That's fractional reserve banking. And I think I do see the crypto industry's point. It's like, hey, our stablecoin is 100% backed. Why are you treating us differently? But devil's advocate for a sec here, Caitlin. I mean, all of our parents need to go out and get mortgages. Maybe you guys want to get mortgages, unless you've struck it rich with your ETH, good for you. But most people aren't in that position. And the banks need those deposits to go and lend out. And I think, is this just FUD when they say, hey, if we let stablecoins get what they want and give yield, all the money that's currently sitting, paying very little interest rate, is going to flood over there, and then JP Morgan, Bank of America won't have money to lend my parents for their mortgage? Is that a legitimate concern?
It is a legitimate concern, and it's interesting because I've been waiting for a rift to develop between the big banks and the community banks, because the big banks want to be all over this, issue their own stable coins, they're opening up branches in small towns all over the country, right? JP Morgan Chase is one of the banks that has a massive growth strategy in bricks and mortar, literally just opening up branches all over the place. They just opened up 2 of them in Cheyenne, where I live, and they're really competing with the community banks. So that's the bigger threat to the community banks, is the big banks moving in. And it's so interesting because I think the community banks have not thought through this enough. But it's really fun because what Custodia is doing with Vantage is a $5 billion community bank based in San Antonio, and we have built a tokenized deposit to stablecoin system for community banks to plug in. And this is the first time that small banks actually have their own payment system that's bubbled up from the small banks themselves. If you look at the history of banking in the United States, the big payment systems, even Visa and MasterCard, were built by the big banks. And the clearinghouse, built by the big banks, owned by the top 21 banks. I have been doing a lot of research into this very recently, and I've never seen anyone talk about this. And in fact, actually, as I've talked about this to banking people, they didn't realize this either. There's a gigantic arbitrage at the center of the banking industry that is in favor of the big banks that hurts the small banks relatively. And I don't know how many people have thought about it, but it's because the clearinghouse is not a bank and it doesn't have the same capital requirements as a correspondent bank. Whereas if the community banks want to do this sort of business, they actually have to have hold 20% risk weighting against the due from in the receivable from the bank. The big banks don't have to do that with the clearinghouse. Whoa. Is anyone wondering why the big banks keep getting bigger, right? And they want to dominate the stablecoin market. So I can't wait for the small banks to make the break. And the cool thing about what Custodia and Vantage are doing, I love working with the smaller banks because that is where the Main Street credit is coming from. So whether you are opposed to fractional reserve banking or not, and there is a huge rift in that area, we can maybe talk about that next, but the community banks are the ones that are on the ground. They're the ones, lending to small businesses. They're the ones, that know their customers on a first name basis. That's more legitimate in my mind than the behemoths that just are too big to fail, keep getting bailed out, and are trying to grab the core deposits from the community banks. And then they build these payment systems to try to keep all the community banks and fintechs out. It's not.
Yeah, and in the 2000 financial crisis, what failed, some very big banks. I want to go back to, forgive me for being slow here, but the distinction between tokenized deposits and stablecoins, because that seems where the action is, to the degree the banking system is touching, the crypto rails. It's at the stablecoin level, but maybe I'll throw this one to you, Rock. How would you explain the distinction between tokenized deposits and stablecoins?
This is more Caitlin, for sure.
So it's the same smart contract. So Ethereum doesn't care what a tokenized deposit versus a stablecoin is. And our smart contract will go live on Ethereum soon. We will probably release it. It's on testnet for people who want to look at it. But in our network, the stablecoin always it starts its life cycle as a tokenized deposit, and it'll bounce back and forth between banks, so bank to bank. Bank A's customer uses it to pay Bank B, then it changes obligor. And then the moment the customer takes it to a self-custody wallet or sends it overseas, it automatically, programmatically becomes a stablecoin. It's the same smart contract, it's the same token, but the obligor changes. So that's what we're doing in the background. We've effectively built what's called a side core system for banks to seamlessly offer this to their customers via a widget on their online banking page, so there's not a big technology lift up front. This is bringing smart contract technology into the banking system, and you guys are going to love this. Vantage and Custodia are very philosophically aligned. We do not want to build walled gardens. We want to tear down the walls. We want to be true service providers. So we did it. We're starting on Ethereum. We're not going down the walled garden, corpo coin, permissioned networks strategy.
Corpo coin, I like that.
So one thing I'll say on that too, and why I mentioned that. So EtherFi, we're neobanking. We're not a bank. There's banking services, I guess, that can happen, but we never take custody of the assets, and we participate in DeFi, which allows us to move quicker, right? Because of how we're kind of set up, we can move faster into different markets, et cetera. So it's actually really interesting learning some of the like legalese and regulatory stuff. We just use the products that are out there, the stable coins that are out there, et cetera. But I think who's going to benefit from this is the users. Like over the next 3 to 5 years, like users are really, really going to be benefiting the most, because there's also going to be a massive customer acquisition play. From all these people to get into this future of banking and what it looks like, or retention from the existing players in the space too. So I think users have a good future ahead of them in the next 3 to 5 years.
I guess I'm just conceptually trying to figure out how to make the two things come together, because banking, you get interest, not much of it, but it's because I lend the bank my money and it lends it out and pays me a trickle of interest. But with like EtherFi, a platform like that, it's the money comes from the validators, and the rewards being shared and then sort of repledged. Is there I'm trying to figure out, is there any common ground between these two worlds, and if so, where?
Probably. So like with Ethereum, if you put your ETH, if you commit it to the beacon chain, in return, you get rewards from the transactions that happen on the chain, right? And so this is the proof of stake mechanism, which gives some incentive to people who commit their tokens to the blockchain. You can withdraw those at any point, but while they're staked, you get some return. I think it's similar to a US dollar in the interest you get back from that, right? You put your US dollar into the system. Liquidity is the most important thing with this, right? You need enough liquidity to kind of make the thing go and make it move forward. So yeah, I think there's a lot to do there. Ultimately, I think what you're seeing in crypto too, they're just financial markets. And I think Hester did a really good job kind of explaining it in just a couple talks ago, but they don't want to block the markets, right? Like, let's just allow fair play in the markets, in financial markets, and I think that's what crypto's trying to do. Because there was no regulation for a while, there's skewed some like misbehaving, fraud, et cetera, but the ethos of crypto and what is possible there, I just think the end state ends up being, like, banking ends up being on the blockchain. That is going to be the end state.
I think all of the $5.7 trillion of demand deposits that I referred to earlier will be tokenized within the next 5 years. And the old ACH system, which is a 1970s technology system, will just be obsoleted, and stablecoins will replace it in tokenized deposits. But again, the difference between tokenized deposit and stablecoin, it's from a programming perspective, it's the same smart contract.
Right, and going forward, I know you've been battling the Fed for years now. My goodness, I think we had this interview like 5 years ago. We're trying to get your master account. And a master account is basically the unlock where you get access to cheap money through the Fed and the ACH system and the SWIFT system too?
No, not the SWIFT system. That's a separate system. But yes, it's basically no counterparty risk and no risk of debanking. We were famously debanked 5 times in 18 months of operating, just simply because we were in the crypto industry, even though we had a crystal clear compliance record. It's literally just, and I mean, it's also obvious the Fed was, certain elements at the Fed, I shouldn't say generally, certain elements at the Fed wanted us gone because of our lawsuit. And if we had lost our banking access, that would have been an easy way to make our lawsuit go away, right?
Yeah.
I think that the image of crypto is kind of tarnished by some bad actors, though, and so unfortunately, crypto, like, bad intent is assumed, right?
Well, I mean, the discovery in our lawsuit showed that it was FTX that precipitated the Fed's move against us and the Fed's move against Silvergate. We had nothing to do with, I mean, Silvergate was banking FTX, but I mean, Custodia had nothing to do with FTX. And yeah, I won't go into all that, but it's just look at the dates. FTX filed bankruptcy November 11th, 2022. The Fed decided to deny Custodia November 23rd, 2022. And I found out through a back channel. We had lots of people coming forward. Thank God Washington, D.C. is a sieve. We found out that the Fed moved against Silvergate on that same November 23rd. So it was obvious FTX was the precipitating factor.
Yeah, and I think Choke Point 2.0 was not a fiction. It was. It happened. But I assume we're kind of like in new era right now, where you do have people like Paul and Hester who are who are like no crypto. So is it going better now, or?
It is, but the Fed still has not let a single crypto native company have access yet. I was just talking with Chairman Atkins and Commissioner Peirce, and they were asking, what can we do to help? And there were a lot of people around, so I don't think I'm breaking a confidence. Chairman Atkins said he's going to call the Fed and get them to have a conversation. There are multiple, both Kraken and Custodia we applied for our Fed master accounts literally 5.5 years ago.
Yeah, it's ridiculous. Let's end on an optimistic note, though. I think it's fun to look into the future because realistically, the ACH is kind of a primitive like email system from the 70s, and you can have a blockchain. So can we see a world where the globe's banking is done on blockchain, and how does that specifically look like? Is that in 10 or 20 years? How long is it, and what's it look like?
Well, I think it'll be a lot faster because the Fed tried to slow, and there are some argument that part of the reason they slowed the crypto companies who were trying to get access down is because the Fed created its own real-time payment system called FedNow, and it didn't want stablecoins to compete with FedNow. One of the problems with FedNow, though, is it was designed for the banking system architecture, which is still, in most cases, closing the books overnight. So there's still a lot of batch processing, no real-time processing going on in the vast majority of the number of banks in this country. It's still overnight. And so the message, I would love to give credit to Lynn Alden because she talks about the data leg of a transaction versus the money leg. We've been able to send the data leg at the speed of light since the mid-1800s when the transatlantic telegraph technology came into play. But money was gold, and it was limited to move at the speed of matter, right? And so when Bitcoin finally came along, you could move the data leg and the money leg simultaneously, so you could truly get atomic settlement. So much of the abstraction in the banking industry is all these layers of not having the ability to move the money and data together.
Exactly. We know we have a better system. We're out of time, but I want to give Rock last word. When is Ethereum going to be part of the mainstream banking system? What's that look like?
I think it's 3 to 5 years. I don't think it's that long. Like, I think we're super, super close. The fact that Paul Atkins and Hester Peirce were here, like, that is amazing in like the growth that we've seen. Things are moving so much faster. And so, like, I know prices are down, and prices drive narrative and the feelings in crypto so much because, like, a lot of crypto is still a casino, and so people are trading, and prices are down, but, like, I've never felt better positioned in working in crypto. Like, I'm super, super bullish on where we're at, and things are moving super fast. So I'd say 3 to 5 years.
If you have a better technology, it'll prevail. I've seen it again and again. Okay, please give it up for our panelists.
Thank you,
everyone.
Well done. Thanks. Thank you.